Good morning, good day. Thank you for joining me. This is Tim Watts, like the light bulb over here at IAMS. Super excited for Loren Hollingsworth to get presenting today. I am joined by Sam Wright over here at IAMS, as well as Griffin Gajero, both on the annuity sales team. Do have just a couple of slides that we're going to present today before we turn it over to Loren. As usual, we'll have a couple of polls as well as the opportunity for you to ask some questions at the end. This is one of our most powerful presentations that we have at the Academy. I'm super excited to have Loren on today, and I'm sure you're super excited to hear about how he can help you out with those tax mitigation strategies for the millionaires and billionaires. So I'm going to go ahead and quickly go through a few of these slides, and then we'll get it turned over to them. So the first thing I do want to highlight is our new Producer Builders program. As you can see, there's several different levels in here that you can qualify for. And what this really is designed to do is to build your pipeline when you first start over here at IAMS, so we can get you in front of those clients that you work best with. Maximizing this out at the $1 million level would be $8,000 for marketing. That's several seminars, that's a ton of preset appointments, thousands of mailers, lots of different options, and you can piece that together any way that you please. So if you want to spend $2,000 on one strategy, $2,500 on another, you're completely under control on that. If you're wondering where you're at on that level of new producer bonus, give myself or your sales director a call. We also have our referred producer program. So when you refer somebody over to us, they get contracted, you're going to get $50. Then you can see there's several great levels of rewards there for every obviously index annuities, MYGAs, SPLs, life target, all that good stuff. Then after your new producer program is over that we talked about on that first slide, you've got the marketing reimbursement. So even after that first 6 months or first $1 million of premium, we're going to continue to invest into your marketing. All right, I'm going to quickly go through back office support. Well, I'm going to go through it quickly. Our teams work tirelessly to help you get from application to commission as fast as possible. Any annuity needs, McKinsey and her team help you out there. Anybody on the life side probably knows Michelle already and her team of fantastic new business folks. We also have a tremendous amount of information on our website. I was literally talking to an agent this morning, and he said, man, I didn't realize how much was available on your website. If you haven't done a website tutorial, talk to your life or annuity sales directors. Ton of information on there, including training, resources, forms, calculators, industry updates, marketing resources, all sorts of different things there for you. EAP Solutions, Luma, Firelight, and those other programs on there is where the industry is going. Submitting your apps via EAP helps ensure that it's going to be in good order and, again, go from submission to commission as quickly as possible. None of these programs cost you any money. We've just integrated them into our business to help you work smarter and not harder. Luma also gives you the ability to get live updates on those contracts, and that's anything that you write over here with IAMS, as long as the carriers are participating in that program. And when you go in there to have that annual review, you don't have to worry about calling the carrier, being on hold. You can go right in there and get all that information at the tip of your fingers. We do have our creative service in-house here. This team does a tremendous and fantastic job of those innovative strategies, getting you all represented in the social media market, and being able to help out with websites, logos, everything that you see there. They are a full service team. If you do have any marketing needs or ideas that you're thinking about rolling out here to finish up 2025 or to start out with 2026, definitely get on their calendar before it starts to fill up, as this is a pretty busy time for the team as we end the year, and a lot of agents are ready for 2026. We do have our marketing analysis. This is an individualized, comprehensive, and specific plan for both you and your sales team over here at IAMS with short and long-term goals and objectives. This is free of charge, but adds a tremendous amount of value because it gives everybody a roadmap. Where are we spending our money? Let's meet every quarter, reassess this, reallocate where needed. And again, is specific to your practice and a great value. If you're interested in getting one of those booked, this is a great time to do that. Again, as that end of year, beginning of year planning time is upon us. I also have our IAMS Wealth Management. Started that over 6 years ago. If you're interested in getting that Series 65, we've certainly helped a lot of agents achieve that certification. This has led to a great organic growth for us over here at IAMS, and we'd certainly love to help you out if you're interested in those assets under management. We do have 3 trips that you can qualify for right now. One is our Beachy King with a theme. Then we've got our Park City with Silac, and then recently announced our two tickets to Paradise going out to Nassau, Bahamas. Going to be a fantastic trip out there. If you're wondering where you're at on qualifications for those trips, this one that's on the screen right now still has plenty of time. You've got to the end of 2026 to qualify. But those first 2 trips, the qualification is coming up here quick. Definitely talk to myself or your sales director to know exactly where you're at on those trips. We will have a virtual Life and Annuity Academy coming up here in January, over 25 hours of seminars and presentations designed to help you as that independent agent hit and exceed those revenue goals. Tips and tricks from other agents that work with us over here at IAMS on how they're successful. We'll also have 4 to 5 keynote speakers presenting live that day. And then we'll kick off our in-person academy starting in April or May of 2026. If you're interested in that, definitely let us know so we can get your name and make sure we get you invited to that one that's virtual. There will be no charge on that one, but again, a tremendous amount of value. Lastly, before I turn it over to Loren, if you haven't liked us on Facebook or connected on LinkedIn, that's a great way to stay connected with us. Get all those industry updates. Make sure you don't miss out on a rate change or a product release. So I'm super excited to have Loren Hollingsworth come on board today. Sure, he's got an official title. However, I like to call him my tax mitigation guru. I think Steve Murray calls him the smartest tax geek that he knows, and he wears that badge proudly because he is really, truly an expert in this space. So with that, Loren, the floor is yours.
Well, thank you, Tim. I'm always impressed by the value that IAMS adds to producers and the extent to which IAMS provides support as they try to build their business and achieve their production goals. It's an honor to be here, and I'm grateful for the opportunity. You're very kind as well. I think tax mitigation guru is a lot better than what I am probably most often called, and that's just a geek, because I am about as geeky as it gets. And not only do I read the tax code, I read the tax court cases. And probably worst of all, Tim, I actually enjoy reading the tax court cases. So that's who I am. And to your point, I do own it. It's just me. So I always like to start, and before even pulling up a slide, by talking about one of the OGs in the industry. Anyone who's not familiar with the name Ben Feldman, I would encourage you to become familiar with that name. In my opinion, Ben Feldman is probably one of the greatest life insurance producers the industry has ever had. And he had a very profound saying. His saying was, go for a guy's wallet and he's going to break your arm. And I think there is significant profundity in that particular expression. I think often as financial advisors or insurance agents, we tend to go for a client's wallet, meaning we want them to allocate some of their current income or assets into different strategies, whether that's life insurance or annuities or assets under management, whatever it is, we're asking them to take their money and put it somewhere else, which is effectively going for their wallet. And so, as I have served in this industry for many years, I have realized that it is much easier and often much more effective to not go for the client's wallet. And that's part of why I have chosen to specialize in advanced tax mitigation strategies. That way, instead of going for the client's wallet, we're literally taking money that would have gone to their least favorite uncle and reallocating that into whatever financial strategies or instruments we're offering to provide the client. So with that, let's dive into what I call the spectrum of tax mitigation strategies. If we can go to the next slide, please, Tim. One more. There we go. Okay. So you can see that I have divided tax mitigation strategies into the three different phases of our lives. We've got the accumulation phase. Theoretically, all of us are currently in that accumulation phase. We're trying to make money and build assets, build wealth. Then we would transition to the distribution phase, which would theoretically be retirement, or what, realizing that everyone views and has maybe different definitions of retirement, but that's when we would be drawing from the assets that we had accumulated. And lastly, we have the wealth transfer or legacy planning phase, which is obviously when we pass away and we're passing assets to posterity or to charities or wherever it is that we design for our wealth, whatever we've accumulated and what's left after what we've distributed to go. So the simplest of the accumulation phase strategies is just a traditional IRA. Very easy to understand. You set aside money into an IRA and you get to deduct that off of your current taxable income, thereby providing some immediate tax mitigation. Once you've maximized an IRA limit, then we could pivot to the more advanced IRAs, which would be SEPs and simple IRAs. And they both provide additional tax mitigation or a higher benefit limit for what you could contribute and thereby deduct from your current taxable income. Well, from the after we've addressed IRAs, then we would move to what we call qualified plans or employer sponsored plans. Those are divided into two categories: defined contribution plans, where the IRS defines the maximum that can be contributed each year and therefore deducted off of taxable income. Those would include things like 401ks and 403bs and TSPs. Those are all defined contribution plans. And again, typically offer a higher contribution threshold than a traditional IRA. From after the defined contribution plans, we could then pivot to what we call defined benefit plans. Defined benefit plans are really the correct term for what most people would call pensions. All pensions, well, at least most pensions were actually defined benefit plans. And in a defined benefit plan, instead of defining the maximum amount that can be contributed into the plan each year, the IRS defines the maximum benefit that could be derived from the plan as distributions or retirement income from that plan. Well, the bottom line is that often by choosing a defined benefit plan, we're able to increase the contribution threshold. Because let's pretend that the maximum defined benefit was around $300,000 a year of income that you could derive from having accumulated the maximum amount of assets in a defined benefit plan. Well, if your actuarial life expectancy was 23, 24 years, you had 300 a year that you could take out of the plan, that means that you would have a bucket of roughly $5 million that you could fill while you were working or accumulating those assets. Well, if you're 60 years old and you have a $5 million bucket to fill by age 65, that means you could theoretically contribute $1 million a year in order to achieve that $5 million bucket to sustain 300,000 each year of distributions for your actuarial life expectancy. So that's where a defined benefit plan has some significantly higher potential thresholds. Now, there are a couple of caveats to that. The first is the IRS doesn't allow you to take the maximum benefit if all you've been taking or receiving during your accumulation phase is $60,000 a year. You don't get to draw a $300,000 a year benefit out the back end. So many people limit or minimize how much income or salary net profit they're trying to pay tax on the front end. And if they do so, then that would also limit what they could pull out on the back end. So for in that situation, the maximum defined benefit would be lower than the IRS established limit. The other consideration is we also have to account for interest, both while the assets are being accumulated and while the assets are being distributed. Because of that, it turns out that the maximum defined benefit contribution I was ever able to achieve for a client was about 460,000 a year. But 460,000 of contribution that comes off of your taxable income could be fairly significant for someone that may be making $1 million a year. So that's where a defined benefit plan can come into play. The other significant limitation with a defined benefit plan is that if you have a lot of employees, you have to provide a commensurate benefit for all of the employees. That makes a defined benefit plan quite expensive if you have more than probably 2 or 3 employees. And so when you have a lot of employees, a defined benefit plan may not be the right or a very viable solution. But if you're a sole practitioner, an attorney, maybe just making money, a defined benefit plan might be a way to maximize the qualified plan contribution and therefore the reduction of your current taxable income. From there, we would often pivot to what we call a defined benefit alternative using Section 79 of the tax code. Unfortunately, those plans have generally fallen out of favor, both with the IRS and with the insurance companies that used to provide them. So we'll skip Section 79 and we'll go instead to captive insurance under Section 831B of the tax code, or what is often its more efficacious brother, which is actually private reinsurance, also regulated under Section 831B of the tax code. Quite simply, the business owner is able to take what would normally be business profits, put them into policies to protect against what we call fortuitous risk to intangible assets, and then reinsure that with their own reinsurance company. So they purchase policies with, pay premium that comes off of their what would otherwise be profits, and then it goes back into their own reinsurance company. They pay whatever claims have to be paid, and then whatever profit is left over is taxable at long-term capital gains rates instead of ordinary income rates. So that's a captive insurance or private reinsurance program under 831B. Next, we have the structured ownership program, probably one of the most powerful tax mitigation strategies on the market today. The structured ownership program simply leverages a client's capital contribution to a new little company. It's called a Cell Series LLC, CELL, Cell Series LLC. The client makes a capital contribution to that company. That company then generates for the client a negative K1 equal to 8 times their capital contribution if we're offsetting ordinary income, or 10 times their capital contribution if we're offsetting long term capital gain. Let me use just a hypothetical example. Let's pretend that a particular client achieves $4.5 million of net profit from their business in 2025. Well, depending upon their marital status and state of residence, they're going to end up paying roughly $2 to $2.2 million in state and federal income tax on that 4.5 of net profit. Again, this is their taxable income after they've taken all of the necessary and ordinary business expense deductions under Section 162, and they've done accelerated depreciation or bonus depreciation. They've done all the other things they can. They're left with $4.5 million. They're going to pay roughly 2 to 2.2 million in state and federal income tax on that 4.5 million. Well, alternatively, they might make a capital contribution of 500,000 to their new Cell Series LLC. It will generate for them a K1 equal to 8 times that capital contribution, i.e., a negative $4 million K1. Well, the negative $4 million offsets $4 million of the 4.5, leaving them only $500,000 of remaining taxable income. Well, on that remaining 500,000, they may pay, let's say, $100,000 in state and federal income tax, again, depending upon their marital status and state of residence. And then there is a program fee for the program that is 5% of the negative K1 that is generated. 5% of 800,000 would be $200,000. So all in, the client would be out of pocket 500 of capital contribution, 100 of tax on the residual 500 of income, and 200 of program fee. They're out of pocket a total of $800,000 instead of having given Uncle Sam, call it $2.2 million. That just put an extra $1.4 million back in their pocket immediately. Well, in that situation, if we've just saved a prospect $1.4 million in taxes, it's really not difficult to ask them how much of that they would like to put somewhere where Uncle Sam could never tax it again, i.e., perhaps life insurance, or how much they would like to set aside into a retirement annuity, or how much they would allocate into assets under management, which you might manage. So that's where we go back to the Ben Feldman concept of taking money from Uncle Sam and suggesting solutions for how that could be better allocated through effective use of tax mitigation strategies. Well, we've got a whole list of other tax mitigation strategies, but I want to get to the Roth conversion alternative concept. So I'm going to just brush through the rest of these. We've got everything from tribal tax credits and convertible tax bonds, buy sell, executive bonus, key person plans under Section 162, deferred compensation plans, split dollar designs. There's a CHAMP or LHMP program, both of which are under Section 125 of the tax code, cost segregation studies, research and development credits, deferred sales trusts, modified installment sales is what they're often called. We've got leveraged charitable gifting strategies. Then you've got things like restricted property trusts, 1031 exchanges, ESOPs, net unrealized depreciation. All of those are accumulation phase tax mitigation strategies. From there, we would talk about distribution phase strategies. Well, the easiest or simplest of the distribution phase strategies is just a Roth IRA, essentially the exact opposite of a traditional IRA. Instead of getting tax mitigation while you're making your contribution, i.e., during the accumulation phase, the tax mitigation is on the distribution when you receive income or take distributions from that Roth IRA. So fairly simple. We also can do Roth conversions. Then we have things like tax-free municipal bonds that provide tax-free dividends or income from those bonds. And then we would have what we call a Roth conversion or a Roth conversion alternative. And that's what we're going to dive into here momentarily. Then defined benefit alternative Section 79 plans came across because they had some tax mitigation on the back end. Captive insurance, as I already mentioned, has tax mitigation on the back end. Whatever profit is realized inside the private reinsurance company is taxable at long-term capital gains rates instead of ordinary income rates. Premium finance can have some distribution phase benefits, but only if we started that premium finance plan when the client was fairly young. We need probably 10 to 15 years before a premium finance design is really effective at providing tax-free distribution. So that would have to be started fairly young in order for that to be effective as a distribution phase tax mitigation strategy. However, it can be very effective at virtually any age as a wealth transfer or legacy planning strategy, which is why, as you see, that comes across into the wealth transfer legacy planning phase. And from there, we would move into some of the more specialized strategies, things like a single premium immediate annuity into guaranteed universal life insurance, essentially leveraging an asset into a tax-free death benefit. Then we have some of the more traditional charitable gifting programs, things like charitable remainder unit trusts, charitable remainder annuity trusts, and charitable lead annuity trusts, and even variations on the CRUTs, things like a NIMCRUT, net investment makeup, charitable remainder unit trust. So some charitable gifting strategies that provide some tax mitigation during that wealth transfer or legacy planning phase. Then we also have things like family limited partnerships, family foundations, support organizations. Of those, family foundations are probably the most effective right now. Support organizations have again lost favor with the IRS, as have family limited partnerships. They keep trying to minimize the reduction in value of the transferred asset for lack of marketability and control. So family foundations, though, are still a very strong way to transfer assets and provide benefit for generations. Obviously, most people, I'm sure, are familiar with irrevocable life insurance trusts and things like second to die or survivorship, indexed universal life, or even survivorship whole life. Both can be effective wealth transfer tax mitigation strategies. So, let's dive now into a discussion about the Roth conversion alternative. So, Tim, can we go to the next slide, please? So, here's my hypothetical scenario. We're going to pretend that Richard is a married 60-year-old man and he wants to retire at age 67. We're going to pretend he makes 80,000 a year, and through hard work and scrupulous savings, he and his wife, we're going to marry him. Like I already said, he's married. We're going to combine their qualified accounts. So he and his wife, through scrupulous saving, have been able to build a balance of $1 million inside their 401ks. Their goal is simply to maximize the amount of monthly spendable income that they have in retirement. Well, I would propose that there are essentially three options for Richard. Tim, can we look at the next slide? The first would be leaving the money inside a 401k or moving it into just another brokerage account in an IRA and keeping it in assets under management, keeping it in the market. Option B would be a deferred income annuity, and option C would be what I call a Roth conversion alternative. So let's explore each of those options. If the money were left inside a brokerage account, I'm going to pretend that it was able to grow at an annual net rate of 6%. That's net of fees and expenses of 6%. Well, if that were the case, just compound math calculator would tell us that at age 67, that $1 million today would have grown to 1.5. Again, this is assuming no additional contributions. We're just growing the $1 million that they currently have in their IRA or 401k in assets under management at an assumed hypothetical growth rate, non guaranteed. I'm just using math here and in 7 years, it would have grown to 1.5. Well, we hopefully are all familiar with what's called the safe withdrawal rate, which refers to the amount or percentage of that qualified account that could then be taken out each year as consistent annual retirement income. And that safe withdrawal rate would be a maximum of around 4%. In fact, the newer white papers now suggest that 2.8 is actually the safe withdrawal rate. It used to be that 4% was what the Monte Carlo scenarios demonstrated had a 90% probability, regardless of what activity took place in the market, of that $1 million or that distribution lasting at least until age 90. From 60 to 90 was what the Monte Carlo scenarios were designed for, but 65 to 95, there's a 90% probability that regardless of what would happen in the market, that if you only took out 4% a year of the initial amount of $1.5 million, then it would have a 90% chance of lasting at least 30 years until potential death at age 95. Obviously, we now know that that's probably a little too aggressive of a distribution rate, but to be as generous as possible with this option, I'm going to assume that we're using that 4% annual withdrawal rate, which means that Richard and his wife would be able to pull out about $60,000 a year from that 1.5 as supplemental retirement income. Well, if we add that 60,000 a year to their Social Security income, Tim, next slide, please. Thank you. So if we add the 60,000 from their 401k or IRA distribution to Social Security income, the average American couple receives about $3,000 a month in Social Security income. That would be 36,000 a year. So 36 plus the 60 would give them 96,000 of annual income minus taxes. I'm assuming 15 federal, 5 state would leave them about 76,000, almost $77,000 a year of annual income. That would be option A, which ironically is the plan that probably 85 to 90% of Americans are thinking should be their retirement plan. So that would be option A. Option B, as we talked about, would be a deferred income annuity. So we would take that same $1 million and we would put it into a deferred income annuity. Well, I'm confident that Tim could affirm that we've got income annuities that on the protected income value would guarantee at least a 7% growth rate. Simple, which means that the $1 million would have grown to 1.6 over that 7 year period. So at a retirement of 67, they would also have a guaranteed distribution rate of perhaps 5%. Again, I'm pretty sure we've got annuity products that would guarantee a withdrawal rate of at least 5% starting at age 67. So that would be 5% of 1.6 million would generate about $80,000 a year in annual income from that very same asset, just allocated instead of being in the market. It's in a deferred income annuity with a guaranteed growth rate of 7 and distribution rate of 5. Well, if we add that 80,000 to their 36 of Social Security income, now their gross annual income is 116. If we take out taxes, again, 15 federal, 5 state, just averages kind of across the country, that would leave them about $93,000 of net annual income. I would submit that 93 sounds a little better than 77 if you were Richard and his wife. So that would be option B. Option C is again what I call a Roth conversion alternative. For the Roth conversion alternative, we would take the same $1 million asset. We're going to assume that what we have not distributed is going to continue to grow at 6%, because what we're going to do is distribute that $1 million over 5 years. Well, because what hasn't been distributed is continuing to grow, that means each year we would be able to pull out 223,000. From that 223, we would now pay tax each year, and you'll notice that I raised the federal rate from 15 to 25% because we just added $223,000 to their annual income. So that would hold out 67, which would net 156 each year for 5 years that we would put as premium in a specially designed indexed universal life policy. And by specially designed, we would utilize the minimum non-MEC death benefit. So we would keep the death benefit as low as possible to maximize the cash accumulation in that particular policy. Well, if we did that effectively, and that policy performed as expected, as it's averaged historically, then they would be able to pull out from the policy $70,000 a year, starting at age 67. Well, if they pulled 70,000 a year from their policy, again, it might be one, it might be a combination of policies, they're pulling out $70,000 a year, adding that now to their Social Security income of 36,000, that would give them a total of 106,000 a year of income. But because the money from the policy is tax-free as a loan against the death benefit, that would keep their provisional income below the taxation thresholds for Social Security income, which means that not only is the $70,000 from the policy tax-free, but the 36,000 of Social Security income would also stay tax-free, which means out of 106 of annual income, they might pay 0 in income tax, netting 106,000. So if you were Richard and his wife, you would have, can we go to the next slide, Tim? You would have under option A, almost $77,000 of net annual income to live off of. Option B, you would have 93, or option C, 106. I think it's kind of a no-brainer. Most people, I think, would choose 106. Now, that's just big picture. There are limitations to the Roth conversion alternative strategy. Most significant among them is the health of the client. This distribution assumes that they would be able to at least achieve a standard rating. So if their rating were less than standard for he and or his wife, then we might not be able to generate the full 70,000 a year from the policy. But assuming decent health for both Richard and his wife, then 106 is a very reasonable projection of their net annual income. So that's the big picture. That's what we call a Roth conversion alternative. Again, quite simply, all we're doing is taking a qualified asset, distributing it over 5 years, dealing with the tax implications of that distribution each year, and putting the balance into a non-MEC life insurance policy. Interestingly, in my hypothetical example, you may recall I used a federal tax rate of 25 and a state tax rate of 5. Well, interestingly, using some of the other tax mitigation strategies I just referenced in our spectrum, we could probably keep the cost of that distribution each year to about 20% instead of 30%, thereby actually netting more that could go into premium into the investment grade life insurance policy. So there are, I would submit, a number of buffers in this particular RCA math, which make it so that that 106 is a very realistic expectation for their annual income from that policy, combined with their Social Security income and paying income tax on none of it. So that's it. Tim, thank you. That's what we call a Roth conversion alternative. And I think it's pretty clear how powerful that could be, providing almost an extra $1,000 a month for this couple in retirement.
Awesome. Thank you, Loren. We do have, it looks like, about 15 minutes for questions. We've got a couple here already, so I'll get those rocking and rolling. And then, group, if you do have any other questions, definitely go ahead and pop them up in here, and we'll see if we can get to all of them. So the first question is, how do we know if the agents are in front of a client that could benefit from your services? Are there any certain, income levels or other factors that they should be looking at?
Yeah, thresholds. It's a great question. And interestingly, Tim, as I talked about, one of the most powerful strategies, the structured ownership program, we can use that to offset both ordinary income and long-term capital gain. But there are two types of income I won't use the SOP to offset, and that would be W-2 wages and qualified distributions. So we would not use the SOP to mitigate the tax on the distribution of 223 in this hypothetical example. But I do have other strategies we would use or could use. We could use leveraged charitable gifting. We've got an accelerated depreciation program, and we also have the convertible tax bonds, which again would help reduce that cost of distribution to about 20% instead of 30%. So the answer to your question is yes, there are different programs that have efficacy at different levels. Generally speaking, Tim, what I would say is that any client that has at least $500,000 of taxable income is probably worth having a conversation, because we would probably be able to save them at least $50,000 to $100,000 in taxes at a $500,000 income level. Obviously, the more income they make, the more we are able to mitigate, and therefore the more efficacious the tax mitigation strategies become. But that's probably a good minimum threshold for income for the spectrum of tax mitigation strategies. As far as using a Roth conversion alternative, I would say that it probably begins being effective at around probably $300,000 to $400,000 of combined qualified assets for a couple that is approaching retirement. So does that answer what they're asking, do you think, Tim?
I believe so. We still have a couple more minutes if they have any follow-ups to it, but let's go to the next question here, Loren, and that is, how does it work if an agent has, some clients that they think would fit that scenario, as far as, setting up the appointment, working with you, fees, splits, whatever that is.
Okay, well, thank you. It's a great question. When I do these presentations, I often articulate that my goal would be to help at least 10 advisors out there write the largest life insurance case they've ever written. And I have dozens of advisors across the country that will attest that they wrote the largest life insurance case of their life by bringing me in to assist with the case. So it's a great question. I would be honored to be of assistance. So each of the tax mitigation strategies that we could utilize would have uh, program fees or a small uh, fee that could be shared with the referral source, i.e., the other advisor that brought them to us. So there's a little bit of income potentially for referring a client to us. And logistically, that's really very easy. Uh, they could reach out to you and you could connect them with my team, or they could reach out to my team directly. And we would just schedule a call to talk to the advisor. And from there, we could arrange to meet with the client, either in person or via Zoom. In terms of commission splits, if we're providing a life insurance solution or a annuity solution for that client, for example, this Roth conversion alternative strategy would generate a rather substantive life insurance commission. I generally ask for the first 10 cases of joint work that I do that receive a 40% split on the commission for the life insurance or annuity product. After the first 10 cases, I turn it over to the advisor to decide whether they would feel that I've added enough value to warrant a 50% split, but I don't ever accept more than a 50% split on the commission on a life insurance or annuity case. And again, I would start at 40% for the first 10 cases that I do of joint work with a producer.
Awesome. And then, as Loren referenced there, if you would like to get in contact with him, just contact one of your sales directors over here at IMES. If you don't have one, of course, myself can help out, and then Griffin and Sam, who are also also on this call here today. Last question here for you, Loren, unless somebody else pops one in, and is the effect of the Roth move also applied towards the IRMA calculation? Is, I believe, what they were asking. So if you did that Roth alternative, that 106 wouldn't count towards the IRMA or the MAGI, correct?
That is correct. However, for the 5 years of conversion, while we're taking the distribution, and again, in our example, the 223 a year would count towards IRMA. It would impact their modified adjusted gross income and could increase their rates for those years of conversion. But the reality, I believe, is that over time, they will still save significantly more by having accelerated that distribution rate.
Awesome. Well, Loren, I will give you just a last minute here if you want to have any wrap up comments. I think all of the questions have been asked. Everybody in attendance here today will get you information sent over with a replay. And I guess I'll go ahead and see who wants to get called first. So I'll go ahead and launch my one and only poll here. And would you like to have some more information on how to connect with Loren? That poll is going. Definitely let us know so we can reach out to those folks who maybe have some clients that would be of good benefit. But while that poll's going there, Loren, any last wrap-up comments before we get out of here?
Well, I think it might be of merit to share my philosophy, and that is I am actually a veteran. I am a patriot. I believe as citizens, we should pay every penny in tax we are obligated to pay and not a penny more. So I am very passionate about what I do. And I also believe that entrepreneurs, like the people here on the webinar, are the very lifeblood of our economy. And everything I can do to help entrepreneurs keep the money that they have made or earned encourages them to continue to be entrepreneurial, which thereby strengthens our economy and our country as a whole. So I really enjoy what I do. I spend a great deal of time ensuring that whatever strategies we're utilizing are appropriate use of tax code. I even have on retainer a tax attorney who is our technical and legal advisor for my company, and we just always want to make sure that what we do is appropriate use of tax code. So
Awesome. Well, on behalf of everybody over here at IMS, Loren, we genuinely appreciate you hopping on here. Everybody out there, we appreciate you hopping on here. We look forward to connecting with you soon. Have a great day. Bye now.
thank you. Likewise.